Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8. So, there's a lot of deals out there. There's a lot of deals that are coming to maturity, and there's a lot of deals that are not able to pay their bills. So they're either going back to the lender or they're trying to figure out, can we refinance this? And then there's a lot of deals that are just kind of testing the waters. What's going to happen when I get a BOV from my institutional broker who says, "Oh yeah, you can get 15 million for this," but the market speaks and it's only 12. So what are the options? And these are the opportunities that you have that are staring you in the face. The question is, who are we going to be partners with? Can we trust them? Tonight, we're going to hear from Shane Pogue, who's going to help you understand how to kind of dig deeper, how to find these partners and find trustworthy partners, and kind of get some background checks on them, see if they're truly who they are. So I'm excited to have the conversation coming up with Shane. Now, if you're working on a deal, I'd love the opportunity to provide the debt. That's why I'm in business. That's why I do what I do. And so I'm looking to understand your deal. How much money are you looking for? How long are you looking to hold this asset? So I'm going to look for your T12, a rent roll, an offering memorandum, and your underwriting. Send me those 4 things and I'll package them. We'll have a discussion. What are you looking for? Do you need some CapEx? Always helpful to kind of hear the backstory. Who's in the deal with you? Because lenders are really looking deep to find out who is qualified. Again, Shane's going to help us who is qualified on that. But once you send this to me, I can get you a turnaround with a loan quote about 48 to 72 hours. And we'll give you some options, what might make sense for you. Remember, the deals, these loans, they go with the market. So what is today's quote may not be the same quote in 30 days and may not be the same 90 days when you close. So it's always very, you want to really stress test these deals, right? So maybe I'm telling you I can bring 70%, but it ends up being 65. Okay. So you really want to make sure you have enough reserves, enough people coming in on the deal. All right, let's get on with the show. I want to introduce you to Shane Pogue. He is the founder of AEGIS RSI. Did I say that? Yes, RSI Solutions and Investigations. So RSI stands for Risk Solution and Investigations. They are a remote due diligence and risk management firm that helps investors, lenders, and deal makers identify, assess, and mitigate risk before deploying capital. That is all of us. Founded in 2024, AEGIS RSI was built on the premise that institutional grade investigative due diligence should be accessible to all investors, not just large firms and family offices. AEGIS RSI serves investors, commercial lenders, and real estate sponsors in multifamily development, venture capital, private equity, and private credit using proprietary frameworks such as the AEGIS Web Map and the AEGIS Risk Rating Matrix. Shane is also an active educator in the due diligence community, regularly collaborating with industry members on podcasts and virtual seminars, speaking on investment communities, and publishing thought leadership on fraud prevention, risk management, and responsible investing. All of us need to understand how we can protect ourselves. So I thought this would be great timing as many of us are getting back into the markets, trying to find capital, making sure that your investors feel comfortable. So Shane, welcome to Zoom at 8. How are you tonight?
I am doing great, Julie, and thanks for inviting me.
Yeah, absolutely. We are finding so many people lost money. And not that they made bad choices, not that every operator was bad, although there are some out there. Um, I think that we're getting into an age, into the new segment that we're going to need to do a little more due diligence. So I'm excited for you to kind of walk through how you can help us. How do we engage you? What does your company do? Help us understand that. How do we protect ourselves?
Gotcha. So one of the big things is that what is due diligence in like an institutional space and what it is in like the private market with individual investors is two completely different things. A lot of the time it comes down to resources and training. A lot of people don't even know where to go. Luckily, my background before I ever joined the finance world, I was actually a private investigator. So I knew how to get in touch with courts, how to get records if I needed them, how to put a lot of detail in the work I was doing. That really helped me when I moved on. But what I kind of saw when I started my business, because I thought it was, I had, when I started my business, I actually got really lucky. I had one client. I did not know this what the situation was in the market. It's not where I saw a gap and I went, yeah, that's a really great idea. I should go in there. I had one client. He used me for pretty much everything, and I started to realize as I was talking to people similar to him, because I was like, yeah, it works for him. It's obviously going to work for these other people. Is that they just didn't have access to any kind of real due diligence. They were doing background checks on guys that they're in $2 million deals with. They're doing Google searches on them and they're saying, "Oh, okay, I think I'm good." That's not how it's supposed to work at all. A lot of it actually requires a huge amount of specialized knowledge and just general knowledge as well. So our process, it does have a lot in common with a background check, and I actually used to do background checks as well, but they are a very different process. So the core of a due diligence investigation is one, of course, finding all those lawsuits and things that you want to actually dig up and make sure that you get the context of them, because the context of a lawsuit matters a lot more than the lawsuit itself. In certain situations, I pull information that people would never want to be known in the public from a lawsuit that they themselves filed against someone. So you're able to pull in a lot of good information. You're able to gauge risk better when you go in and you go say, hey, let's not just look at the things he was a defendant on. Let's look on the stuff he was a plaintiff on. Let's look at the let's look at the cases that don't seem like they're really serious, and let's pull in all that information to track these risk behaviors across several years. And what we typically see when we do that is people typically act the same ways. They don't change seriously over time. A guy that had historical financial issues from creditors is going to probably have them into the future. And that's not a people don't change speech, just what something we have observed while we're doing when we're looking into financial risk. It's very hard to change who you are as a person. So we go in and we make sure we get all the information we can on these lawsuits. And then we, of course, do things like open source, which is just a fancy word for Googling things and using specialized web browsers to make sure that if a person's done something that's newsworthy, we're the first ones to tell you about it. Um, but one of the really core aspects of what we do is actually analyzing the people's own marketing materials and pitch decks, because you can actually find a lot of red flags just there. Actually, we caught a Ponzi scheme last week where there was almost nothing on them. They had like a very minor securities violation from Arizona, and they weren't even incorporated in Arizona. So it was kind of weird to find that. But a lot of what the issue was it wasn't something that like just jumped out at you. It was they made a claim. Um, it was something regarding court how foreclosures works in the courts, and they were basically saying, "Hey, we can pull money out of this process." Well, if you look into that process, the actually pulling money out of that would take a very, very long time. And they were saying, "Hey, we can turn this around in like 3 to 6 months, and you get your money back." Not only did their process not really make sense, their timeline also didn't make a lot of sense. So their business had only been around for, I think, 8 months, and they were saying we can turn this around in 3 to 6 months, and then that they've already done thousands of deals. So you start to look at it and you're just like, these numbers don't make any sense and we can't analyze this. And this was sent to me by a Wall Street veteran, someone that knew what he was doing, has looked into investments before, and he went, "Hey, can you look into this? I mean, we have you on hand. Let's go ahead and do it." So one of the big things is you people are having problems because of the quality of information they're getting and how they're retrieving that information. So you want to make sure that one, the information you are getting is quality information. You don't want to go and do an instant background check and then realize, oh, this actually brought in a lot of records from a guy that's not even related to my guy. They just have a similar name, which does happen an awful lot. I actually had one recently where a client sent me an instant background check that told him that a contractor he was working with was a sex offender. And I was just like, I can check that in 5 seconds. That's not a hard task. And the instant background check just completely messed it up. And that was that guy's livelihood. I was like, yeah, of course I'm going to do that for you. That's no problem. And you kind of want to make sure that when you're getting that quality of information, you want to double check everything. So if you have a lawsuit, you want to double check all the details. You want to make sure that there's not countersuits, things like that. That might reveal more information because there's two sides to every story. You can get sued for pretty much anything. Um, if you haven't yet, you probably will at some point. I know I definitely will be getting sued at one point because someone's going to look at what I do and go, "Oh yeah, that seems a bit sketchy. How do you determine all this?" Well, it's a very structured process, so it would be a very short lawsuit and it's very legally defensible. But at the end of the day, at some point in your time in business, you're gonna get sued and it's gonna kind of suck. But at the end of the day, I pull information from that, so I don't really care. Secondly, after you get the quality of information, you want to make sure you have someone that knows what they're doing looking into that information. The difference is that is really stark. I can take someone that knows how to investigate, that's done background checks, that's done even financial risk modeling and things like that, and it will take me about 6 months for them to actually do a due diligence investigation. The reason for this is that people bring a lot of biases into just how they interpret data in general. And one of the things you want to do is try to limit those biases. You can't ever completely eliminate them, but you want to limit them to the point where if you're looking for something, if say you just look at this guy and it seems like fraud off the base, maybe he's just the type of guy that's like, oh, I've got this flashy car, I've got all these things. And to someone that works in due diligence, that's an instant red flag for fraud risk. If this guy's raising money, he hasn't been in the game that long and he has all these fancy assets, we're going to look for source of wealth. Well, if you find that source of wealth, it's not an issue anymore. But if you don't have the foresight to go in and look for that source of wealth, make sure he could possibly have had that stuff before he started raising money, before he doing all this stuff, then you're going to run into the issue of you're saying, hey, this guy might be committing fraud, and he's not actually doing that. It doesn't realistically make sense. Of course, you do for every case like that, you have a case where the guy has been raising money for 1 year. He had a job that maybe made him less than 100K every year before, and then he's buying a sports car right after he finished a big raise, and that's always a big red flag. Because you can never track the source of wealth well enough through there. On top of that, you want to make sure that when you're looking into information, that you do not jump to too many conclusions. One of the really cool things I actually get to do in my work is when I'm working in the venture capital space, I can work directly with founders. That is one of it sounds a little bit annoying, but at the end of the day, they can explain things that might not be completely apparent when you're first looking at the data. So for example, I was working with this guy and all of our data was pretty solid and we got everything we needed, but he didn't understand fundamentally why we were checking into businesses he owned previously. He was like, "Well, these are different businesses. I didn't invest in the I you're not they're not investing in this business, they're investing in this business. Why does this matter?" And it's why, well, because we're working with a fund and that fund is a venture capital fund, and when you're working in the due diligence space, if you have previous failed businesses or current businesses with extra debt, that's a financial and a potentially a fraud risk. So we have to disclose that to everyone so that they know about it beforehand, so that our client doesn't get in trouble, you don't get in trouble, and I don't get in trouble for doing bad due diligence. And
Mhm.
being able to work with him like that really changed his tune. And suddenly he was volunteering a bunch of information, sending me court documents that weren't publicly accessible. And of course, when someone does that, you have to check it with the court as well and make sure it's a real document. That's one of the very basic steps of document verification. If you receive a document, confirm it with a primary source, not with who they told you gave it to them or who they told you confirm it, because that's just a really quick way to do it. If you call the court and say, hey, is this document filed? They'll say yes. And you can very quickly go, okay, yeah, this is a valid document. So once we got through that, I was able to mitigate some of the risks just because he had satisfied from some judgments that weren't publicly recorded. He had settled a lawsuit already, but the court website hadn't updated it. And the clerk didn't want to give me the information on it or something like that. Usually, that is one of the biggest things. And one of the things that actually really helped me when I first started out was I used to be a private investigator, and you have to talk to people a lot as a private investigator. So, being able to build relationships is a big part of it, and it's not just with people like that. It's also your clients. A lot of the time, I spend a huge amount of time talking to my clients just about what their risk profile is, what they're okay with, what they're not okay with, things that they might want to be red flag that, from my perspective, might not be big red flags for me. And when I do that, I can kind of go back to that quality of information and make sure they get the information that they really need. For example, I have a client that is almost always going to be, it's actually a lender, but they almost always want to know about any kind of high risk or high dollar sign lawsuit. Doesn't matter how likely it is it's going to turn out in their favor or against the person they're looking to lend to. They want to know about it. They want to know the amount. They want to know what's happening. They want to know if there's any rebuttals, anything like that. They want that highlighted. They want it rated as high because they see it as a lending risk. When I'm working with a real estate investor, that might not be a big risk to them, because it might not have anything to do to their property they're investing in. It might be something that's going to be mitigated out because it's a fund to fund model, and it's not going to be something that's long term going to affect the business. So it's completely changed the risk profile. And if I've lost you so far, I'm going to pause for a little bit for questions.
Yeah, no, that's really good. So let's kind of walk through. The people in the room are investors, but they're
Mhm.
also general partners that are looking to get to know the person that they're going to be walking hand in hand with. So it's very similar profile, an investor to a general partner or general partner to general partner. So kind of walk us through what that would look like, how we would engage you, um,
Mhm.
what the steps are, how long the process is, what the cost is, how we would do that.
Gotcha. So the process for a general partner is a little different than if you're an investor.
Okay.
The reason being is if you want to let most of the time when I'm working in a group and they're like, hey, I want you to vet all the general partners here, I'm going to be looking into all the general partners added as a request from everyone. So, especially if there's some kind of employment agreement involved, I have to get everyone involved, like legally, under the FCRA. If you're doing something like what I do and there's some kind of employment agreement in place, you have to get their consent to do it. Most of the time, I don't have to do that because all it is money changing hands. But if it's regarding an employment, you have to go through and make sure everyone knows what the process is, what we're doing. So, say we're going in and we're looking to a general partner team, and we want to just make sure that we're disclosing all the risks to investors. That if we don't know about certain risks, that they're brought to the attention of the leadership, and you guys can decide whether or not you want to keep that person on the team. Um, which is it's a very messy process, but sometimes that's why you want to do this process way before you need it. Because if you don't offer this guy anything, he doesn't have an employment agreement, and he's just a general partner, you can go in there and do this whole thing without telling him, and then say, "Hey, no, we don't want you on the team right now. We'll look into you in the future." Things like that, where you can just quickly mitigate the risk before it even becomes a risk. From a LP perspective, that's a little bit different. a lot of the times we go into an incredible amount of detail for our LPs just because they don't have a lot of access to this kind of information. So a big syndication team, they might have people doing risk management for them. They might have a lawyer looking over documents. But when we're looking for LPs, a lot of the times we're the last stop. The first and last stop. So they have access to us, and then they might have some access to like a deal's lawyer or something, and then that's it. That's all they're going to get access to. If we don't catch it, it's not going to get caught. So we'll go into a lot of detail, not just on the operator, the risks involved. We'll also go even whenever we're evaluating a syndicator, we go into their track record and and verify that with property records to make sure that they're being truthful and that they don't have any liens and judgments on the property that could potentially affect the healthy investment. But for LPs, we like to do that extra step because it will really, really help them long term. And we do that with GPs as well. It's just the process is a lot less. Hey, we're trying to vet this guy's entire track record to make sure everything's okay. To we probably know that if this guy is engaging us, he already kind of knows what he's doing and he knows it's a valuable process and he's not going to sit there and try to BS us on a track record. We're going to find something and he's going to confirm it. Um, this our actual process usually only takes around 5 to 10 days. In some really complex situations, sometimes it takes longer, or we have to consistently work on something for a while. So usually, if we're on our initial report, it's going to be 5 to 10 days. We'll push that out, and then we'll work on whatever we need to work on afterwards, so that you constantly have some kind of due diligence support, some kind of risk management support throughout whatever deal you're doing. And that's a very important distinction because we don't like to function as a vendor. We like to function as a partner. So some of our clients, they even have us in their marketing materials as like partners are like, oh, this is our due diligence partner. I actually prefer it that way, not just because it's good marketing for me, because it really helps LPs ask questions. So sometimes I will get questions from people that I don't work with that say, hey, they said you're working with them. You did this report. Can you confirm that? I'm like, yes, I did this, and this is the risks involved. I'll just reiterate whatever was in the report, and let them know if they have any questions, they can contact me, and that really does help because I don't know if you guys have realized it recently, but people have been a little bit skittish with their money.
Yeah,
Capital
for
raising's
sure.
gotten a little bit harder. It's just because a lot of people got burned. There was a ton of different things that people got burned in. There was car washes, there was ATM fraud, there was just the general syndication environment. People were getting burned left and right, and now they're being careful. Which is very good for me because I help people be careful. I don't necessarily want them to, well, one very clear thing I have to tell everyone is that I am not an investment advisor. So if you ask me, would you invest in this? We usually tell you legally, I cannot tell you that. Like I cannot say, hey, yeah, you should invest in this or you shouldn't invest in it. All I'm doing for you, I'm doing the due diligence, looking in the risks, and then I'm telling you what I found. Um,
So
you, if you,
I'm sorry, let's just unpack this a little bit further. So Scotty has a deal, and Nicholas in the room here, Nicholas wants to do some due diligence on Scotty. Also wants to do some due diligence on the underwriting. Do you help through that whole process? Do you step in and you do a underwriting or a due diligence background check on Scotty? Walk us through how Nicholas can engage you to and what his expectations would be.
yes. So if Nicholas wanted to look into Scotty, the first thing we would do is I would do a very quick check. Just very detectable things over sources I can get a hold of a lot quicker than most people. And just across the board, make sure that that's something that Nicholas even would want to invest in. Because if I find a big red flag, like, hey, this guy got convicted of fraud 10 years ago, Nicholas might be like, hey, no, I don't want to invest in that at all. I don't even want you to look further. We can fix the problem right off. If we don't find anything, we're going to go into a full report. So what that looks like is usually between 25 and 40 pages. It's going to include all that stuff we talked about, and then I'm going to deliver that to Nicholas. And once we deliver that to Nicholas, then the process kind of changes. So we deliver the report, and then Nicholas might have questions. So we answer Nicholas's questions. He might get a document later on during the process where he goes, "Hey, can you guys take a look at this? I think there's some issues here," or maybe just wants us to take a look at it for in general. Um, or maybe they didn't send over their underwriting right away and it doesn't come till after the report, so we can't put it in the report and we look through it and then we'll revise the report to include the underwriting. So, what we do when we look at underwriting, it's actually a very simple process and it goes back to exactly what we do on everything else. We look for the holes and we look for the bad parts of the story. If you don't necessarily have to break down actually, I have a guy that can break down underwriting to an insane degree that I recommend when people are doing huge deals, but we'll go down and break down the underwriting. Is the insurance cost realistic? Are the actual pricing, do the pricing actually make sense? Is that what it's being, if it's a property that's being publicly sold, is that what's being advertised? Because sometimes and I don't know why people do this so much, but you'll get something in the underwriting and the purchase price will be completely out of whack with what it's publicly being advertised for. And you go, is that what you're buying it for? So you have to kind of check if it's like, how long has it been on the market? Is that a reasonable price? And in some cases, all it is a question that you ask the sponsor. You go, hey, the purchase price online says this, and you guys said quoted that like $2 million less. How are you getting that? Can you get some confirmation there? So sometimes all we're doing is teaching you how to ask better questions, so that you're not sitting there going, "Oh, okay, this deal looked fine, everything looks good. I've worked with this guy before. Let's go." Um, it's adding another step to the process that helps you manage risk. So we would go through, we'd look through all that stuff. We would verify any additional documents, answer any other questions. Sorry about that. Any other questions Nicholas might have. And then we try to continue that support as well. So we do what's called active monitoring on anyone that we look into. Right now, we do close them out at some point. It's just only when the engagement has officially stopped. So right now, we have something like 300 individuals that we're tracking through different means. So we're looking for fraud convictions, high dollar lawsuits, things like that, and that comes into a actually I get an email blast about it every couple of days.
Hmm.
So if it's something big, I'll actually look through it and go, oh, okay, let's bring this to the attention of the client, or this doesn't seem like that big of a deal because of course it's a combination of Google alerts and a not sure if it would be called a software, more like a subscription service, I guess, that we use that does that
Yeah.
for us. Um,
So an
and we can put
automation kind of thing is what you have
yes,
on.
because if you do it
Okay.
manually, it does take quite a while. And for
Okay.
a while, I was doing it manually. So basically you would schedule, hey, I'm gonna look into this guy again at this hour and then or on this day and then look through everything and make sure that nothing new has popped up so that you need to bring someone's attention to. And this is actually a really important part of the process, even though it does sound a lot really involved. We've actually caught people getting sued by the SEC through this process.
Mm,
Luckily, in that case, our client had already decided that it was too high risk to invest in, but
mm.
it was one of those situations where I was like, yeah, we caught a lawsuit by the SEC very early on before any of the other investors the guy knew had even heard of it. And he was able to spread that around his network and let them know, hey, there's problems here.
So Scotty wants to do business with Nicholas, wants to bring Nicholas onto his deal. Nicholas says, I'm a GP. And he's actually a co-GP, which, in the eyes of the investor, they think, oh, yeah, so Nicholas
Mm,
has done deals and he has full control. But he really doesn't. He's a co-GP, which in the eyes of a lender is he's not signed on the loan. He
mm,
is not necessarily misrepresenting himself, but it's not, he doesn't have the authority to, be making decisions. Okay.
mm.
So Scotty calls you, wants to check on Nicholas. You have to have Nicholas's okay to run a background check? Is that what you
No,
had mentioned?
we were in that situation. Usually we would not. The reason
Okay.
being, unless Scotty had already hired Nicholas for something,
Okay.
And we do like executive due diligence audits as well for like teams that are kind of large. We just want to make sure everyone's staying on the right path. There's no issues, there's no financial risks that are popping up. But yeah, so if Scotty wanted to do it before Nicholas was employed or had any kind of agreement with them, and it's only with employment agreements. If they are not
Yeah.
employed with you, you do not have to get their consent. Um, because there's a whole bunch of different laws, state in different states and federally that you have to abide by if you're using even if you're so there's two different processes you want to do when you would hire someone as an executive. You do a background check and then you would do a due diligence investigation. They kind of inform each other, but they're very different processes. So you want to make sure you do both. Um, for example, with a background check, you're going to actually get records usually directly from the police. You can pull records directly from the FBI. When you're doing a discrete investigation, you're pulling all those records yourself. So it takes a lot longer, it's more involved. But because of that, you also have that little shield where it's like, hey, Scotty doesn't have to tell Nicholas about this. He can just get out ahead of it and make sure he does it before he loses money because Nicholas says he's a GP on all these deals. We don't see him on any of the loan documents. There's nothing there that indicates that he has any control over the deal. That doesn't mean he's necessarily inexperienced, but is something we want to bring up as a risk. We want to say, hey,
Yes.
but he's actually a co-GP on all these deals. Did he represent that correctly to you? This is actually a really big problem in the real estate
Big
syndication
problem.
space.
Very big problem, everybody. So heads up on this. And what you're saying, Shane, is you can pull to that degree of information and you can provide that.
Yes, it is actually a lot of that is public record. And you can pull loan documents, you can pull all sorts of things from,
Right. But how many of these investors are doing that? I mean, it's so much
well, it can be
easier
expensive.
to call you and can do this background check for everybody. I mean, this is what you do. You do it skillfully. You understand what is something to as a red flag. Whereas maybe somebody who doesn't have that background, they may think of it's more of an issue where it's really nothing, and vice versa,
Yes.
right? Which you can help navigate.
Yes, and experience is a big part of it. That's another reason why it takes about 6 months to train a due diligence investigator because they need that kind of that experience under their belt to know how something is going to turn out. Not necessarily turn out because we're not predicting the future, but know generally how
Mhm.
something is going to go, what kind of risk it actually involves. Because you might have a really horrific sounding lawsuit, especially if you worked in something like
Yeah.
medical malpractice or medical devices. Some of those lawsuits, if you read through them, they are some of the nastiest things you will ever hear.
Mm.
And when you actually look at the risk involved, sometimes the risk is actually low. So this guy might be manufacturing a medical device. Someone might file a lawsuit and say, "Hey, it caused gangrene or something. You had to amputate a foot." And of course, the lawyer wants to describe that in incredible detail in the complaint. So you look through it and you're like, "Oh, okay, I should not have eaten lunch before I did this." Um, and
But at the
then
same time, they may be calling every person into that lawsuit who had nothing to do with it, and now a red flag is coming up on them, and it really shouldn't be from
Mhm.
a investment standpoint. I mean, there's a lot of doctors in our community that are doing deals, whether it's as a limited partner and trying to work with other doctors, or they are the general partners and you're trying to get information about that doctor. So making sure you understand what pants they're wearing, and how it will affect the deal is really important. Um, so with all of these losses that we've had, these investors, as you meant, they're a little skittish. Our investor pool, retail investors, are really skittish. And so a lot of people are going to GV or JV partners. They're going to pref equity. They're going to a family office. Now, in this case, would a GP team do a background check on a pref equity lender, and or would they also, would the pref equity partner do a background check on the GP team? I assume it's going to go from the pref equity to the GP team, but what about the other way, GP to the pref equity? Because
I have seen
where's
it
that
go both
capital
ways
coming?
actually.
You have, okay.
Because one, a lot of people when they work with a lender, and this is something I've worked with a lot of my clients on, is getting them to understand this. When you're working with a lender, it really matters who you work with. I worked with some really great lenders that do special situations and things like that, and I tell people exactly what they do so they know beforehand. If you go into that thinking they're going to give you a traditional loan with a low interest rate over time and everything's going to be great, that's not who they are. Then that's not what they loan to. So I'm not going to tell you about them if that's not what you need. But they vet everyone they work with. Doesn't matter if it's a vendor or a
Okay.
or someone they're loaning money out to. And from the same perspective, if you're getting a lot of money from them, getting this debt exposure, that's not free money. You want to make sure it's coming from a good place because what if they've burned? And it happens more often in areas like merchant cash advances and things like that. But it does happen in commercial lending as well, or like commercial real estate lending as well, where you're working with a lender that has really poor due diligence techniques or really poor risk management techniques, and it keeps bleeding over. You see them going into places like one of the craziest ones that I've had to track is this lender kept lending to Tide after like even after they had all their issues where it was just like okay you're seeing these issues beforehand and you're still giving them money,
Mm,
what's going on there?
mm.
And it came out to like they just weren't really doing a lot of due diligence on them. They were underwriting the deals and saying hey let's go.
Well, and there's this thought that these lenders are loaning to own them, that they're
Mm,
really they're really knowing that this is not going to work out and they're going to take it back and they're going to get a good price for it. And so in that case, it does make sense to run some background checks on, and I would think that you could see how much debt they have on their books, or I mean, how would that report look?
ooh, those reports usually look pretty crazy because
Yeah.
there is no realistic way to track someone across every county in the US, and that's actually how our court
Mm,
system is laid out. It's by county, it's not by state. Sometimes they have a unified state database, but you still got to go pull stuff from the county because
uh,
at the end of the day, they might report criminal and civil cases to the state, but they're not going to report foreclosures. So if you don't go into their actual county website and go look with their clerk, that's just not going to appear for you, and you're going to go and say, "Hey, oh, this is completely fine, no foreclosures on the record, nothing like that." And then you go into the actual property records and you go, "Oh, wait, there it is, right there." Um,
So that's a lot of work, and that's why you would want to hire you to be able to do it efficiently. I mean, 5 to 10 days is nothing. I mean, when we work with lenders who do the UCC searches, when we bring on a general partner into a deal, every person on that deal has to go through a UCC. Let's say
mm,
you 5 days before close, you're short, you have to bring somebody else in. That person has to go through UCC searches, which take
mm,
about 7 to 10 days. And so you got to, your services are probably what a lot of these lenders are using. You're underwriting those deals, underwriting the people. These lenders are going to you for those services. So makes a lot of sense. You had given me a due diligence report. Would it be okay if I shared it with everybody
Oh, absolutely. That is, I share that with a bunch of people.
okay,
The one I shared with you, I think I
yeah,
put a note on the email. It is a little bit old. We did change some things on our
sure.
reports. We're always changing them just to make sure that we're keeping up with different risk. We're keeping up with actual fraudsters who like to, switch up their tactics occasionally. But this is a one of our our an example of one of our due diligence reports. No one in this actually exists. We actually got in trouble when we first started making these because I ended up making a person that almost exactly matched the profile, even lived in the same city as a person that was real and worked in the real estate industry. And I was like, oops, I did not mean to do that. And had to
Wow.
change the whole thing.
Okay, so this one is a little bit old, but this I want you guys to see what you will get, kind of similar to this when you engage with Shane's company. So why don't you walk us through some of this here?
Absolutely. So this whole first part right here is just telling you what we're doing. We always want you to know what we're doing. It's not secret squirrel type stuff where we're like, oh, we want to keep this all close to our chest. The basic process, we tell you what it is. The things that we protect are things like our risk rating matrix and our AEGIS web map system, which is a system for detecting different, and you will see an example of that in a little bit. It's a system of detecting businesses registered to a person regardless of
Mm,
how well they try to hide them. So when we're going through, we'll go through a proprietary database search. That's just whatever database we're using. Usually it's something like LexisNexis,
mm,
something like that. We occasionally change them because they can be a little bit unreliable at times. So if we just start with those and we just did that, it would be an absolute mess. We do look through our own internal records. At this point, we've done, I think, over 1,000 reports. So our own internal records have a lot of data in them, and sometimes we have GPs that have pulled in um, that have been pulled into multiple teams, and we can actually carry over their profiles and keep expanding out the information so it's current. We'll of course tell you where we searched and what we did so that you know, hey, this is where this guy searched. If you guys and actually if a client sees a gap that they noticed, we will go ahead and do that search as well. So if you say, hey, I noticed that you didn't search Delaware here. A lot of the times we do search Delaware just as a matter of course because
mm,
there's so many businesses registered in Delaware. It's honestly just crazy. Wyoming's getting that way too, where you have to search it every single time. But we almost always search the Delawares just because people register their businesses there, or they're partially registered in Delaware, and you want to make sure that you cover that base. We will go through the SEC social media review. This is actually a really important part. We have caught some
mm,
crazy frauds just by looking at someone's social media or their wife's social media in some cases.
mm,
Um, and our enhanced open source media review, we do two methods. We actually did start using deep research last year, but we also do our own sources as well because what we usually find is that deep research, it's a really great tool, but you can't only use that or it's going to miss stuff. And sometimes it misses some important things. Sometimes it's just stuff that we would prefer to put in the report and it's not. In one case, we had one where this guy had just bought a distressed property and had actually gotten shot on the property. And
oh,
we wanted to disclose that to the investors, but their AI basically, I asked it what it was actually thinking, not including that. And it basically told me, hey, he was a victim here. That's why we didn't include it. I'm like, yeah, but that shows that the property might be unsafe. If we find other indicators, it might increase the risk. We always tell you what we didn't use as well. This is important because sometimes we almost always search FINRA because you would be surprised how many people have been barred from the securities industry and then went on to private equity. If they're clear about that and it's been a while, sometimes it's not a high risk. I think the lowest we've ever rated it though is high risk because if you've been barred from the securities industry, there was a reason for it.
mhm,
We always like to check professional designations if they're available, or if it's something. For example, you said there's a lot of doctors in this group. We actually do check their license, um,
mm.
especially if they
Smart.
have especially if they have malpractice cases and things like that in there. You want to be careful. We had one really bad case where it was a nurse and they had several drug charges against them, and they had lost their nursing license from it, and then they moved into real estate syndications and didn't really disclose that. And they very, very heavily misrepresented how they left the nursing industry. I didn't expect them to say, hey, I had
Mm.
drug problems, but framing it as a very clear cut pivot where you were just really successful in the real estate syndication area. So you moved over into nursing when the time when you were not allowed to be a nurse and when you founded your real estate syndication business was a year. That's a risk. You can't, and if the SEC caught onto that, you might be in a little bit of trouble because you did not disclose that to your investors.
Mhm.
Um, this is our risk rating matrix. Basically, it's an overview. We want to break down the risk so that it's easy to understand and that you're not, because some of these reports, they can get well over 40 pages at points, especially if we're bringing in a lot of people, like we're doing a whole GP team. It can be a very long report. We want to make sure that you can very quickly look through and know what we've actually found. If there's something big, it's going to be put up here. If it's just a bunch of little things, we're going to put those as a 1 or 2 sentences so you understand what's happening. We did start doing property risk assessments. We call this our exhaustive risk model. We do this on property risk, market risk, just basically anything our research skills can support, we'll go ahead and put it in there. This is more geared towards those actual GP teams, so that are the syndicators, so that they can gauge the risks of investing in a property. Um, Things like floodplain exposure, they get overlooked a lot. And when you cannot get flood insurance and your
Yeah.
underwriting isn't tuned to that, you can be in a lot of trouble very quickly.
This is amazing. So there kind of walks you through the
Yeah, so
severity
we
of it.
we definitely want to give as much information as possible. We do a brief overview. This is just a business registration types thing. We tell you where they're registered, if they're not registered properly, and what they do. We do a risk breakdown for every single principal and every and the main
Oh,
managing company. So it'll
okay.
repeat itself, but that's because all those risk profiles actually informs that overall risk rating.
Okay, that's what I was wondering about that. Okay. These are all the
So this is
associated businesses.
Yes, we
Okay.
will try to map out as many associate. It's of course impossible to do every single associated business. It would just be there. Certain states have different laws regarding what actually has to go in there. Um, the way we usually catch those is similar naming conventions. We, excuse me. The way we catch those is similar naming conventions being registered in the same state. Of course, New Jersey is one of the big ones where they don't like to give us a lot of information. We still get affiliated companies in there because, for example, they'll name all their companies something similar. So we'll just search
Mm,
that search term and be able to pull up all their businesses. Even though the state of New Jersey is not going to right away tell us, hey, yeah, this guy is registered as business, we can see, hey, this business is registered in the same town as all these businesses, they match the same naming convention. That's their business. And we will also constantly update that process happens very early on in our investigation because of course we need to know where to search looking for um, by looking for different issues. So we want to make sure we know where we're searching first. And we'll actually update that as we go. So if we find a business we didn't discover in our web map in a lawsuit, we're going to include that and we're going to use those naming conventions too and build out the web map even more so that we know exactly what happens. And as you can see, we like to go into a lot of detail on lawsuits. The reason being
mm,
the context of a lawsuit is one of the most important things. Um, in certain situations, it might turn a potentially high risk issue into a low risk one very quickly if you can go through and mitigate the risk. One of the biggest mitigators is, of course, if a lawsuit is closed. But in certain situations, there's not a lot of good ways to mitigate the risk. For example, a federal fraud lawsuit is not a very mitigatable issue, though occasionally they are. We actually had one recently where um, it was a retaliatory filing. So it actually lowered it down to a medium risk rather than a high risk because they had filed a lawsuit against a business partner for doing something that seemed borderline illegal. We pulled up that, and then almost like 2 months after, they're getting sued by that person for fraud. So we have to go through all the different filings and counter filings and everything and make sure we're providing a balanced picture of it. And what we actually came up with is it was not as big an issue. One of the big things we changed on our reports is now rather than a judgments and lien sections, we actually just have a whole financial section. So anything related to finances will go in that section. The reason we did that is because we started having people ask us for do things like asset overviews and other things that might not necessarily fall under a judgment and liens category. So we ended up changing the whole category and making sure it was all encompassing for financial risk rather than just judgments and liens. We do
Wow,
like to
this
go.
is really incredible.
We
So
do like
much
to go
information.
into the track records. That is a very important part in the syndication space. Honestly, syndications are some of our longest reports, not necessarily most complicated, but it's just because we're going through a lot of detail. There's a lot of moving parts. People are investing across different states, and you want to make sure that you're checking on those properties. Even if we don't necessarily write that we checked on every single property, we definitely check on every single property even if we don't put it in their track record. Basically, what our track record is we're taking a sampling. Usually it's a random sampling or a sampling of things that seem a little bit suspicious, like high returns, um, things that might be older in their track record. We like to focus on those because occasionally someone will bring in, and this goes back to people not being honest on what they were doing. Occasionally people will bring in things that they didn't have full control over. They were an LP in the deal and they decided they wanted to list it from whatever for whatever reason, and or they were a co-GP and they're not showing that, hey, I didn't actually have full control over this deal.
Well, and this is interesting, the social media findings, because like you mentioned, that speaks very highly of people trying to get around. Now it's low risk, but it does show some of their integrity, maybe potentially, or how they behave.
Yes. And if you have a bunch of low risk issues, those can build into a bigger problem. Um,
Yeah.
Occasionally, we get low risk issues where they form a pattern. So you have a guy that, and honestly, this is something we've reported before. We have a guy that just had an insane amount of speeding tickets, and we're talking about over 50 in a 1 year
Yeah.
period. This guy's running
Crazy.
he's running this huge fund, and it's like, yeah, he can probably afford this ticket, but why is he getting all these?
Yeah.
And then you look into his business profile and you see very similar risk issues where you're like, okay, wait, this guy is just a risk taker. He keeps going and doing things that he knows are going to get him in trouble and just does them anyways. So you look into that and you start building a profile of the person, like a personality profile, and you go, oh, okay, this guy might be a little bit higher risk just because, of course, just because of traffic tickets, we're not going to rate someone high risk, but this guy's a little bit might be a little bit higher
But
risk than the next guy.
it does make you think, hmm, what kind of character am I getting involved with? So this is amazing. I have learned so much about you and about the process here. Does anybody here have any questions for Shane? I know we did not cover the pricing. Maybe you should go over that first.
Gotcha. So we actually have very flexible pricing models. That's just because we work with everyone. We start our my favorite pricing model is our subscription model. It's just very easy for me because what we do is right now we have what's called quarterly subscriptions. It's about a little bit less than $4,000 a year. That's like 20 reports. That covers most people, or most active investors. And then we have another model where it's just if you're an LP, you don't do a lot of deals, maybe to two deals a year. You can come to us and we'll just quote you a price on based on the work we're going to have to do, and we go from there. Most of our reports on that line of business come out to less than $1,000.
Okay. Okay. And you that can save you a lot of heartache and a lot of money in the future. So it says that Todd Bailey has been working with you for about 6 months. Todd, give us your thumbs up for the process for his company, or
Yeah.
Shane.
Hi, Shane. Nice to see you again.
Hey, Todd.
Yeah, I've gotten some really good information from these reports. It's comforting to read a report and not see the red flags, right? Because a lot of, and I asked Shane, how much of the information is publicly available that I could go dig up if I wanted to, which I don't want to do. I don't want to spend the time doing it. And how much of it is behind paywalls. And there's a mix of both. And obviously, the paywall information I don't have access to, and I wouldn't even know where to start. And so it's very comforting to read a report thoroughly. They're well done. They're much deeper than I could ever go. And then gain trust in my potential partner or gain trust in an investment. It's also interesting to read a report where there are significant red flags. I was going to invest in a debt fund, and the debt fund operator went through personal bankruptcy and had many other orange and red flags on his. Now, personal bankruptcy could be medical bills, it could be anything, but there was a pattern of behavior that steered me away from the investment, and that was an
That
LP
is
investment,
worth
not a
it.
partnership, right? So very valuable. I endorse
Wow.
Shane's company wholeheartedly.
Gosh, that's incredible. Shane, if someone wanted to get a hold of you, Aegis RTI, how
Or
would we do?
RSI.
RSI, sorry,
Okay.
RSI.
So we can do, actually, you know what? I will put it in the chat for everyone. You
Okay.
can always get a hold of me through LinkedIn. I actually need to pull up that link because I closed everything because my computer's been acting weird lately. I tried to open a web browser in Zoom yesterday and it crashed everything. I was late to a meeting. So I don't know why it's been doing that, but I'll go ahead and put my LinkedIn profile for everyone. That's a very good way to get a hold of me quickly. Most of the instant messages go straight to my phone, so it's a really quick way to turn things around. I'll also put in my email so that you guys have that.
And that for
Either of
those
those
that
work
are
for me.
okay, and any of those people that are watching this after in the YouTube video, that's Shane Shane Pogue Pogue at AEGISRSI.com. So there you go. Thank you so much for this information. I hope it was helpful for all of you.